Hello, bankers. Welcome to Learning Sessions. I'm Himanshi Malik, and this is part 2 of your chapter 25C. That is the 25th chapter and module C. Okay, so we in the previous lecture we discussed about net present value method of taking investment decision, where we at the end we concluded that NPV is good method of evaluating investment if we are just evaluating individual investment, because it tells us if the return is positive or negative, but we cannot compare the two returns, right? And another disadvantage that we discussed was that NPV is based on assumptions of future cash flows, and they can be uncertain. They are not sure that these are the only costs that we will have to incur. Sometimes sudden cost occurs, and due to which our whole calculation can fall apart. Okay, so then we are going to discuss today internal rate of return method that is going to overcome some of the limitations of net present value method, but not all. So we will see it in detail. But before that, if you are appearing for JIIB exam, then I want to request you to check out this course in which we are providing you everything that is covered in your JIB syllabus, that is Maha pack of JIB early bird, that is valid till exam. So to enroll in this course, you can download our app, Learning Session IBF exam app, that is available on Android and iOS both, and you can check out the course and what all material you're going to get, and you can check the demo lectures on YouTube as well. Then you will be able to make your decision. If or you can click on the link in the comment to access the lectures. Okay, so do enroll in the course to prepare the course in a detailed manner. We are going to discuss everything in much detail. So let's start with today's lecture, that is internal rate of return method. Before I start this topic, I just want to quickly recap what we did here in the previous lecture, where we discussed discounted method for investment appraisal. The first one was net present value. How do we calculate net present value? We take PV of cash outflow, cash inflow, and we minus PV of cash inflow from it, and we get net present value, right? To calculate PV of cash inflow, we take the future value of cash flows, multiply them by discounting factor. And the formula for calculating discounting factor was 1 divided by 1 plus R raised to power T. So that is our net present value method. Today we are going to discuss internal rate of return. Very interesting topic, so watch very carefully. I'll go really slow so you're able to grasp all the concepts. Okay, so whenever we are making an investment, the most common thing that we notice is our return on the investment, right? If I just take a very simple investment example, when I invest my funds in bank, what I evaluate? I evaluate the interest rate I am getting, that is rate of interest that bank is giving. And to make my investment decision, I compare different banks interest rate, and whichever bank is giving me higher rate of return, that is the bank I'm going to invest my money in, right? Very simple investment decision we all have taken in our life. Now what if in practical scenario also you can get one rate of return with which you can evaluate all your option and choose the one which gives you highest return, right? It would make your life so much easier instead of calculating NPV, because NPV does not help you compare. But when we take return in percentage term, we are able to compare the returns, right? So that is why internal rate of return is used. So it is like the rate of return of the project that you are considering. Now, let's go back to the basics. We already know how to calculate the return on a project. What is the formula for calculating return? Simply cost and the return we got divided by cost, right? If I invested 100,000 today and I got 1,10,000, so what is my return? My return is 10,000 divided by 1 lakh, 10%. Isn't it how we calculate all the return on our projects? Answer is yes. But in practical scenario, we know that we cannot always use this formula. And the answer is we have one small barrier, that is called your time value of money. Because the investment we are doing at 0 point of time and the return we are going to get in future on year 1, year 2, year 3, year 4, and to compare these values with each other will not be a accurate mathematical calculation, right? So that is why we need to use the internal rate of return for formula. Okay, so what is this internal rate of return? Rate of return, how we are going to calculate? It is based on a simple formula. Okay, IRR on a project is the rate where NPV of future cash inflow is equal to NPV of future cash outflow. Okay, so whatever the rate that is your internal rate of return of a project. Just like we have rate of interest on bank, and that is the interest rate of interest on your project. The concept is point at which NPV of cash inflow is equal to NPV of cash outflow, or in other words, I can say where IRR is the rate of return on which NPV of the project is 0, right? Because if present value of inflow is equal to present value of outflow, my net present value is going to be 0. So that is the concept of IRR that you need to remember. What? NPV is equal to 0, and the rate at which NPV is equal to 0 is your internal rate of return of the project. That is the return that your project is going to give you on average in its life. Okay, and to make the investment decision, how do we make the investment decision? We are going to consider two factors. Number one, if we are comparing two projects, the decision will be based on higher IRR. Whichever project has higher rate of interest, that is the project we are going to choose. And number two is if we only have one project, then we compare IRR with the cost of capital. You remember we calculated cost of capital because each source of fund has its own cost. So wherever the IRR is higher than your cost of capital, it means that project is going to be profitable for you because your cost is lower, your return is higher. Ultimately, you are going to make the profit. So that is the concept of internal rate of return in making the investment decision. I have given you the theoretical basis of the topic, and I hope you are able to understand it. Now we will go to the calculation part. But for once, I need you to look at it carefully again. Okay. Okay. So I hope you are clear till now. Now let's just remember our first lecture on this chapter where I taught you to calculate net present value. Now you must remember in that calculation we were already given a rate of return that we used to calculate the NPV, right? We had a rate of return in each project. But in IRR, we need to calculate this internal rate of return of the project. And that is our ultimate calculation. So, how do we calculate the rate of return is the question here. And the answer to that is we use a method called trial and error method. Plus, we use interpolation method. These two mathematical concepts we use to calculate the ultimate internal rate of return. Okay, so what do we mean when I say trial and error? Because I don't know for sure what is the IRR of my project going to be. So, but one thing I know, the whatever IRR is, at that rate NPV is going to be zero. So I'll just calculate NPV using 2 to 3 different rates, and by using NPV from those rates I can calculate the IRR at which NPV is zero. Okay, so this is a mathematical concept you will understand when I solve the questions. Let's just go through your notes before that. What does it say? Internal rate of return method. It is the rate at which NPV of investment is what? Zero. That I already told you. The discounted cash inflow is equal to the discounted cash outflow. Only then your NPV will be zero. So this method consider time value of money, right? So NPV is equal to zero. To make the investment decision, we compare the IRR with the cost of capital. Where IRR is greater than the cost of capital, the project should be undertaken, and where it is lower, we should not undertake the project. So this is an example that is given to you in the notes that isn't much clear. So what I'm going to do, I'm going to take a separate example for you, and from that you will be able to evaluate it easily. Example on internal rate of return calculation. So case scenario is so we have an investment opportunity where our investment is rupees 1000 today. So this is my present value of cash outflow, I can say, right? That is 1000. And this investment is going to be for 3 years. And over the 3 years, I'm going to get return like this. Year 1, 2, 3. The return will be 400, 400, and 400. This is my return. Now we just know it very simply that we cannot just go ahead and compare, okay, 1200 total minus 1000, the 200 return I'm getting. Answer is no. I need to calculate the present value of the future cash flow first, and then ultimately calculate the net present value. But for that I need rate of return. That is the situation here. We don't know what the rate of return is going to be, so we will take trial and error method. It means I am going to calculate the rate, and I will see at which rate my investment is getting zero NPV, and that is your IRR calculation. So for first scenario, I'm going to take rate as 10%. Okay, that is my first scenario. And for the other one, I'm going to assume the rate of return at 12%. So how does the calculation go? We know the steps to calculate NPV. First, we calculate the future cash flow. Now, here we already have our future cash flow. The second step is calculation of present value of future cash flow. So, calculation of PV of future cash inflow. Year 1, 2, 3. Future value is 400, 400, and 400. My discounting factor, or what did I teach you? We call it PVF. What was the formula of present value factor? 1 divided by 1 plus R raised to T. So by now, I hope you all have learned how to calculate the discounting factor. For year 1, the discounting factor will be 1 divided by 1.1, that is 0.909. And for year 2, my discounting factor will be 0.826, and for year 3 it will be 0.751, right? And the PV will be 400 into 0.909, 363.6, 400 into 0.826, that is 330.4. Then we have 400 into 0.751, it is 300.4. So the total is 363.6 plus 330.4 plus 300.4, 994.4, right? This is my PV of cash inflow. What is the next step? Next step is to calculate NPV. NPV is equal to PV of cash inflow minus PV of cash outflow. So cash inflow is 994.4. Outflow is, what was the investment that I have to make? 1000. So the outflow is 1000. It means my NPV at 10% is 5.6. Now tell me one thing. Is this rate, this 10%, my internal rate of return? Answer is no. Why? Because the internal rate of return is the rate at which NPV will be 0. But here I am getting minus 5.6. It means NPV has to be some other rate. So we will take a higher rate this time. I'm going to use the calculation by 12%. Same method. For calculating NPV, first we need to calculate future present value of cash inflows. We take year 1, 2, 3. We have our future value 400, 400, and 400. We have the PVF, that is. Now at 12%, how we calculate the PVF? Now there is one more method of calculating PVF that is easier. Watch carefully. What is the rate? 12%, right? What I'm going to do to calculate PVF on calculator, I will take 1 divided by 1.12, right? This is what I'm going to type on the calculator. 1 divided by 1.12. When I press equal to 1 time, I am getting year 1 discounting factor. Okay, now solve it with me. 1 divided by 1.12 is equal to 0.8928. This is the PVF for year 1. Then press equal to one more time, you will get PVF for year 2. That is 0.7972. Then press equal to one more time and you will get PVF for year 3, that is 0.7117. So you're clear on that? Now this is how we calculate the discounting factor on calculators. So you need to learn these small tricks so that you can solve questions quickly in exam. So what will be the PVF? For year 1, it will be 400 into 0.8928. That is 357.12. For year 2, it is 400 into 0.7972. That is 318.88. For year 3, 400 into 0.7117. We get 284.68. So the total is 960.68. And in this case, my NPV will be PV of cash inflow minus PV of cash outflow. It is minus 39.32. So now I have two NPV at two different rate. Both of them are not equal to 0. But I need the NPV at which my the rate at which my NPV will be 0. So from this we take the next step. Remember I told you it is a two-step approach. First we have to calculate trial and error NPV. For that we can take any two rates, preferably 10 or 15% you take. And after calculating NPV by these two methods, the next step is calculating the real internal rate of return by interpolation. Now, how do we do this interpolation? Let's see that. So for interpolation, we have a formula. What is the formula? The formula goes IRR is equal to lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate multiplied by higher minus lower rate. Are we clear on this formula? You need to learn this formula very well. This is the basis of calculating IRR. Okay. So the lower rate in our example, 10 or 12, which one is lower? 10. 10 I will take plus NPV at lower rate was 5.6. Now this is minus 5.6. Then NPV at lower is minus 5.6 minus NPV at higher is minus 39.32 multiply by higher minus lower, that is 12 is my higher rate, 10 is lower rate. So 10 plus, now this plus will turn into minus because plus minus minus, right? Divided. So on the calculator, we're going to type minus 5.6 minus 39.32. That is also in minus. So the answer is 44.92 into 2. 10 minus 5.6 divided by 44.92 into 2 is equal to 0.249. So the IRR is 10 minus 0.249. 9.751%. This is the internal rate of return on this project. So now tell me one thing, what can we conclude from this rate? So are you clear on the calculations? Let's quickly recap it. So what have I taught you? What is IRR? The rate at which NPV will be zero. IRR is the return that my project is giving me. And to calculate IRR on a project, I need to see the rate at which NPV of the project is zero. To calculate this, we use trial and error method. We take any two rate of return and from that we calculate first NPV, right? I've taken 10% and 12%, and from these I calculated NPV that we learned in the previous lecture also. So this is a revision of your NPV calculation also, right? So I get minus 5.6 and minus 39.32 NPVs. Now I have two NPVs. I can use this in the interpolation formula, that is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher minus lower rate. And by solving this, we get our ultimate internal rate of return. What does this internal rate of return mean now? If the cost of capital is lower than this rate, then I accept the project. If the cost of capital is higher, then I reject this project. So if a project has IRR of 9.751% and the cost of capital are 8%, 9%, 10%, and 12%. So this is this cost of capital. I can write KE, and this is IRR. What is IRR? 9.751. Case 1. Cost is lower, IRR is higher. We accept this project. Case 2. Cost is lower, IRR is higher. We again accept the project. Case 3. Cost is higher, IRR is lower. We reject the project. And case 4. Cost is higher, IRR is lower. We again reject the project. So this is how we make investment decision with the help of internal rate of return. Let me know, are you clear so far on this concept of IRR? I've taken it very slow for you so you can, understand not only the significance of this concept that I have taught you in the notes, right? But I've also taught you how to calculate it, because that is what mainly matters. So I hope you have written this example. If you have not, I'm just showing it to you again so you can take a screenshot or note it down, I would say. This is your question, and that is the solution we have taken. First, trial and error method to calculate two NPVs. After that, we have taken interpolation to calculate the IRR of the project, and this is the investment decision we take. Clear? So let's go back to the notes. Now we're going to discuss some limitations of IRR. First limitation of IRR is that even though we have calculated the return on the projects, and we will only invest in the project which is giving higher return, one thing we are ignoring, that is the duration of investment, right? For example, if a project is giving me 15% return in only 1 year and the other project is giving me 20% return in 5 years, so even though the IRR of project B is higher, but the period is also high here, and that is not considered in IRR. So it is not a completely favorable method of taking investment decision. And IRR assumes that cash flow are reinvested at the same time as the rate of project. That whatever return we are getting from the project, we are going to reinvest it at the same rate, and that is the assumption that is taken in IRR. This is a comparison summary of NPV and IRR. So NPV is a sum of present value of cash flow, both inflow and outflow, we get NPV, and IRR, at which sum of cash flow is equal to sum of cash inflow is equal to sum of cash outflow, that is your NPV is equal to 0. NPV is expressed in absolute term, we get the rupees amount of the return, right? But IRR gives us percentage term. NPV will tell us what is the surplus we are going to get from the project, what is the surplus money we are going to get, and IRR tells us point at which there is no profit and no loss. That is your break even point. Because see, NPV 0 means whatever we are invested is equal to what we're getting in return. There is no profit, no loss. And the rate of reinvestment for immediate cash flow. So we in NPV we assume that reinvestment is at capital rate, and IRR we assume it is at IRR. How do we take decision? If NPV is positive for a project, we take the project. But for IRR, how do we take the decision? We choose the project with highest IRR. And if there is only one project, then we take the project if IRR is higher than the cost of capital. Okay. So that is the comparison between the two method. In case of IRR, there are n number of cash flow. There will be existing number of solution of IRR, means more than one solution will pose a potential problem for decision maker, whereas NPV will generate only one figure. So we have covered the first part of this chapter, that was discounted method of calculating cash flows and taking investment decision. The next part is non-discounted cash flow method, where we are going to discuss payback period method and accounting rate of return method, and see how investment decisions are taken from this. So we will cover this aspect in the next lecture. Till then, you revise your IRR, try to solve a question or two on this so that this concept sits perfectly in your mind. Okay, and let me know if you were able to understand this concept quickly or you were facing any problems, so I can help you better. Okay, now let me know in the comments if you were able to solve these questions on your own. If you are not, we will see how I can help you further. Thank you so much for your time. See you in other lectures. Bye bye.